Well, yeah, I mean, I think what you said is really important, because when I say the word retirement, we automatically have this preconceived notion or connotation that we have to be old to do that. Why not retire when we're younger? It's, if you sit down, you do the math, it's possible. And the barrier between being the person who has to work their whole life and maybe never retire versus someone who can retire very young is literally just financial literacy. And this, I think, is just a really powerful message that I suppose is really important to share.
Hi guys, this is Jazz Gallant here from the Protrusive Dental Podcast, helping you get more fulfillment from dentistry and increase your passion for dentistry. Today we're talking about money, right? It's a massive taboo topic. And what I've found is whenever you attend one of these sort of dentist type lectures on money and finances, it goes on and on about NHS pensions, which just bores the life out of me. So I'm hoping it's going to be a little bit different. I've got someone called James Martin, who recently started a really cool Facebook group called Dentists That Invest, and he'll go into the full name of the group and all about it very shortly. But I wanted to get him on because he's someone with loads of raw opinions and so much energy. He is, I think he said he was a 2016 grad. So he's a young dentist who has got into investing and trading. And I thought, wow, what a great opportunity to discuss with you guys about investments, saving for the future. And because personal finance is something that's poorly taught wherever you are in the world and wherever profession you're in. I mean, I always talk about, I want to cover topics in this podcast that are poorly taught at dental school, but personal finances are just poorly taught or not taught, full stop. And what I mean by that is savings and investments, ISAs, compound interest and the power of it, what to invest in, real estate, stocks and shares, that sort of stuff, how to get started. So these are all the things that we're covering today. So the Protrusive Dental Pearl I have for you is very relevant to that. And it's this: lifestyle creep. Lifestyle creep is when, imagine or remember when you were a student, if you're not a student already, and you were living off beans on toast and you were going out once or twice a week, maybe more, some people, and you'd have the cheap 2-bottle pound of wine, and you know what? You were so happy, you were loving it. You know, be a cheeky Nando's now and again, and you were very content in life. Then when you qualify, you start making some money, you then start going to fancier restaurants, start taking fancier holidays, and then, 5-10 years later, everything's creeping up, you're driving a nicer car, which kind of makes sense, but this is exactly what lifestyle creep refers to, is that as your earnings increase, your lifestyle and the sort of expenditure in your lifestyle also increases, which is fair enough because we earn to live, right? We earn to make a good living and enjoy all the finer things in life. But actually, we should also remember that we need to save money. We need to invest money. We need to help it grow in a pot to help us in the future for what James Martin will discuss as being a defensive approach. And for me, it's about protection, security, and freedom in the future. So the more lifestyle creep you have, the less your savings rate, the less money you're saving every month. And savings are so important. And the earlier you start investing, the better. So just be mindful of lifestyle creep. Be careful not to have that sort of graph whereby as your earnings increasing, your expenditure is increasing completely proportionally, because otherwise you're not really saving anything significant. So that's my little financial Protrusive Dental Pearl for you. And just remember, guys, I am not a financial advisor. James is not a financial advisor. Please take everything we're saying with a pinch of salt. We just want to help you guys with our experiences with money and investments. So I hope you guys enjoy this episode. Let's dive right in. Hey, James.
Hello, Jazz. How are you today?
I'm good, man. Call me Jazz, my friend. Jazz is just fine.
I didn't want to be presumptuous, Jazz. I thought we'd start off with Jazz and then
So good, man. What's that behind you? Is that like a little arcade thing, or?
It is actually, yeah. Do you like your old school games, retro games?
Well, who doesn't? But I'm not massively into it. But I just, you see that it's just like a blast from the past, isn't it?
Yeah, it's awesome, this thing. I got it from the trades fair. So it's got like all sorts of retro games on it. It's got your Sega Mega Drive, your Nintendo, all that jazz. Yeah, it's quite cool. Do you want me to pull the camera? Are we recording right now? I don't know if we're recording yet or not.
We're recording, but it just starts recording. It's no big. It's fine.
Okay, yeah, we can edit this part out, maybe. Okay, we'll freestyle a little bit. If it's good, we'll keep it in the show. Let me show you. But no, I don't think. Can anybody at home see this? I don't know. We're on podcast, of course, aren't we? But yeah,
that's right. But they'll be watching the video as well. I've got some people who like to watch the video. Some people like to listen. So that is cool. So what for those listening right now, James is showing me this amazing, like, arcade game type thing on steroids.
It's kind of like an old school games or cabinet. It's pretty cool.
Where's home for you? Where do you live? Where do you live, James?
Leeds.
All right, but you're not from Leeds, are you? You're not from Leeds, are you?
No, I'm not. You might have noticed the accent. It's from Northern Ireland.
Okay.
Originally, but I've been over here for so long, I think it's mellowed somewhat. I used to struggle at the start for people to understand me, and that doesn't seem to happen so much anymore. So I think things have improved. So this is my my English. This is my PC. How can I say? My well spoken. I speak well now. When I go back home, my granny says that I have an English accent. I talk like the Queen. Just everything's relative, isn't it? Accents are relative.
James Martin, welcome to the Protrusive Dental Podcast. How are you, my friend?
I'm smashing. Thanks for asking, Chaz. This is my very first podcast. I'm really looking forward to it. I think it's going to be brilliant. I'm excited.
I'm surprised. You come across really well on camera. I've seen some of your YouTube content. And obviously, for those who haven't heard of you, the reason why I brought James on the podcast is that he started this really cool Facebook group recently. I imagine it's mostly UK dentists at the moment, but I don't see any reason why dentists all over the world will not be able to join this group.
Absolutely. Yeah, absolutely. I mean, the thing is, I actually started it off. I literally didn't expect the first thing. I just thought I'm quite into investing and trading and things like that. I know for a fact that there are other dentists out there who enjoy it. We've got a group for cake bakes dentists. I just thought surely there must be one that exists for investing.
Listen, there's a group for baking. There's a group for air frying. There's literally. I don't know if you're kidding? But so dentists who own air fryers have their own group.
Oh wow! I'm going to get on that. Thanks for making me aware of that. But yeah, and I almost second guessed myself because I just thought surely somewhere in the world has had this conceptualized this before me, because it is quite a thing. And I think as well as that, maybe it came along at the right time. For us dentists, given the way COVID is at the minute, there was uncertainty. There is uncertainty. We don't know if there's going to be a lockdown too. Boris has publicly said that this could be possible. Now, whether or not he's fronting, that's another thing. You know what I mean? He might just be blagging. I don't honestly know. But at the very least, it's sensible to hedge your bets now. And regardless of timing, regardless of COVID, regardless of any of those things, I think that going forwards, just what I've learned about investing, I'm surprised. I wish I would have done it sooner. I really wish I would have started thinking about it sooner. And what we'll get into later is the difference between investing, I suppose, and trading, and why there's a bit of they've been tarred a little bit, I think, and they've got a bit of an unfair reputation, and people think they're a lot more risky than they necessarily have to be. Obviously, there's always inherent risk, but like I say, we'll delve into it a little bit later. But we certainly will do.
And those who haven't sussed it out already, the group is all about investing. So dentists that invest. But and what's the full name? What's the full title of the group so people can join?
Dentists Who Invest, community group for dentists who enjoy trading, if anybody fancies it. And it's on Facebook, just to make that clear as well. And yeah, as I say, it's for anybody who has an interest in investing already or wants to get into it, just as a means of diversifying themselves, learning more, protecting themselves from the way forwards. And I honestly think that it's a defensive thing to do, to hedge your bets. And I suppose, just as to broaden your horizons, broaden your common interests. And the long-term goal, I suppose, for me is to give myself a nice, healthy pension pot so that I can relax when I'm older. And money is very much, it's not the be-all and end-all, but it is a means to an end, effectively. And that end is to have a happy life. You live life on your own terms, and you can do whatever you want because you're not hindered.
That's a really nice summary you gave there. But there's two observations I've made about this group already. So obviously the title is Dentists That Enjoy Investing, but you've obviously clarified that actually it's for those who may be new to it as well. And the newbies are welcome. If you know nothing about investing, because you've seen already, James, the number of posts where you're getting on the group at the moment saying, hey, the name really caught my eye, but I have zero idea. I have no idea what I'm doing, but I'm really excited to learn. But then also there's some posts on there already, and I'm like, whoa, I don't understand what any, because I'm not a trader. I'm more just a set and forget type of investor. We'll come into that a bit later. I'm very excited for this chat.
Yeah.
But you got it all. So I just want to just dive right in. But before I guess you get into the meat and potatoes of those types of questions, like when should you start investing, blah blah. I just want to find out when did you qualify? And you obviously work in Leeds. We sussed that out. But when did you qualify? And then eventually, how far after qualifying did you get into trading? Or is this something, dare I say, that you were doing as a student?
Short answer is no, I didn't start trading when I was a student. I started trading in 2018, but I'll come to that in 2 seconds. So first of all, as you said, I qualified from Leeds University in 2016. I still do reside in Leeds. I originally came from Northern Ireland to go to university in Leeds, 2011. Stayed in Leeds, obviously, the whole duration of my course, 2016. I made it as far as Sheffield for a year, and then I came straight back to Leeds. I did my FD year in Sheffield. I just really like Leeds. I have a lot of friends here. At the minute, I am not working because I've recently had surgery on my knee, you see.
Oh, right.
So I'm likely going to, unfortunately. So ACL surgery. So if anybody has torn their ACL, they'll know what I've been through. It's no fun whatsoever.
Rugby or what were you doing?
Football, really bad football tackle. Yeah, but it's quite skiing, I think, is another one that's quite commonly people get it in. But really bad tackle in football. It was about a year ago. I've only recently, COVID somewhat delayed the schedule for the surgery, and I've only recently got around to having it. So it's good. It's on the mend. It still aches if I stand up too much. And I don't do myself any favors as a dentist because I talk, I'm animated. I kind of spend more time out of my chair than in it because I'm moving around the room. Maybe that's something I need to work on, definitely. But as I say, at the minute, I'm recovering from that. It still aches and throbs, you see, if I stand on it for too long. So I suppose, in a way, this was the kind of initiated or kind of encouraged this genesis of this group, because I have all this free time. I've been spending some of my time, as I generally tend to do, and as I have been a lot over lockdown and for the last 3 years since I got into it, investing and just reading around and learning more about it. And that's kind of inspired the group, I suppose. And it's why I've been able maybe to grow the group to the level the way it is, because I've had so much time off. I've been able to interact with the group members, give them value, and just perpetuate.
There's a lot of engagement on that group, and the group is more than just investing. I think, from as you created it, but as someone who's observing, I think it's more than investing. It's all about money management. Like you said, money is such a huge topic. It's a taboo topic, which makes it which makes me even more excited to have this chat today with you, because it's a topic that we should talk about more. And I don't want to come across as, dentists are greedy type thing. But listen, we're all going to have savings. We're all going to have pensions. We need to sort of be able to have an idea of what you want your money to work for you. And that's exactly what we're talking about today.
Yeah, definitely. I think you're on the right lines with it being a taboo thing. And there was once upon a time, a younger self, where I thought to myself, I almost had this inherent distrust of anyone who wanted to advise me on their money, because I just thought that their interests were not necessarily aligned with mine. But the more and more I've read and the more I've learned about money management, I realized that, believe it or not, by leaving your money in the bank, there are inherent risks to doing that, which you can avoid and protect yourself. We talk about investing has this connotation of something aggressive, where we go out, we're kind of making these investments, we're trading, we're watching charts, stuff like this. There's a lot of risk to it. There's a chance that we might win, but there's also a good chance that we might lose. But my message is, I suppose, that it's actually a defensive thing, because by leaving your money in the bank, you actually lose quite a lot of it through inflation. And the inflation figures that the government report are actually quite a bit lower than what they are in reality. Because of that, if we surely leave our money in a bank and we kind of have all our assets in cash, then at that stage, we're putting ourselves at risk, because we're very much at the whims of what inflation is doing at any one stage. And there are certain ways that you can actually hijack inflation and make it work for you and your investments and grow your money and protect yourself. That's the main message.
But Jane, before we continue, we must do our due diligence, which is this, okay? It's like a disclaimer. I don't like to have disclaimers on my show, but me and you are not financial advisors, okay? Any decisions you make based on this episode, okay, I'm totally down to you. We have nothing to do with this. We're just two guys that have philosophies on money and investing and stuff. And I'm sure you're a trader, I'm an investor. We probably have different philosophies, and we can totally disagree with each other today, and that's totally cool. But I do think that we have probably a lot of similarities as well. But firstly, seek financial advice properly if you need to. This is not going to give you, we're not qualified to talk about money. We just like talking about it. Okay, so that's just bear that in mind. But just on that point of inflation, really great point great way to start the episode. Inflation, money sitting in a bank account is a bad idea. Can you just make that tangible for us?
Yeah, sure. Maybe I'll just flesh that out a little bit so it's a little clearer. So let's say we have £1,000 in our bank account. Inflation is the rate at which your money depreciates in value every year. Okay. So when you have £1,000 in your bank account, after a year, if inflation rate is 10%, then that means that your £1,000 is still £1,000, but it only has the value of £900. So you can buy, the previous year you could have bought 1,000 chocolate bars. Next year, you can only buy 900 chocolate bars, something like that. You know what I mean? And really, I think the real call to action that I learned that gave me the drive, I suppose, to start looking into how I might protect myself against inflation is how much it's underreported by the government and how they mess with the figures. I can get into the technicals later if anybody's interested, but let's just suffice to say, typically it is, I didn't use that 10% mark. I didn't just pluck it out of the air. It actually is generally around that mark. And
wow. See, James, I didn't know that because, to me,
it's amazing.
You consume the mainstream media, and the mainstream media will tell you it's more than 3%. Am I right?
Yeah. Or at the minute, it's actually purported to be around 1 or 2%, but they might be slightly more accurate at the minute because there is not very much demand from, broadly speaking, from most economies, from most goods, because of what the coronavirus effect it has in the world. But anyway, that's another story for another day. So anyway, they'll broadly purport it to be something along the lines of what you've just said, Jazz. So maybe 1, 2, 3%, whereas in actual fact, in reality, it's more about the 10% mark. If you don't believe me, I'll give you a short thing you can look at online if anybody's interested. It's called the Burrito Index. Feel free to look it up and what Jazz and yeah, it's good. It's actually a measurement of how much burrito you get every year. It's an American thing, so it breaks.
Because there's also there's other indices as well, right? About how much something is worth, but that might be different. For example, that's completely different to the Big Mac index. The Big Mac index is how much a Big Mac costs in different countries, right? That's completely different. That's not the same.
I think that's just a comparison between what your money's worth in different countries, as far as I'm aware, from what I've read of it. But the Burrito Index is something slightly different. It's just a comparison of how much bang for your buck you get in terms of burritos every year in America. That is obviously quite a trivial. It's just one example, I suppose, but it's just a nice way of explaining it that I've come across.
Yours is good, James. Yours is good, and we can definitely put that link. So please do send me that link so I can put that in the show notes. But essentially, cool. the reason why inflation is a good starting point to discuss this conversation is because that in itself is a good reason to start exploring where else we can keep our money not in a bank account because of the reasons that you said. And also, maybe you're going to mention this, and correct me if I'm wrong, because I do feel as though you're ahead of me a few levels in terms of your knowledge with all this. So I think once you get to over £80,000 in a bank account, you're no longer protected, right? You don't get the FCPS protection.
I have to admit, I haven't heard that, but okay. Yeah. I mean, I actually thought it was around the 50,000 mark, but anyway, it doesn't matter. There's
a certain level, basically.
There is a not unrealistic amount of money that you can store in your bank account and at which point you begin to lose protection. And at which point, you're quite right, Jazz, it's a healthy thing to do to begin investing, how you might diversify what you own to protect yourself, just like what we said earlier.
So that's perfect. So how did you get started? I'll share my journey in a moment, but how did you get started? So you knew about the inflation and you thought, okay, I need to start saving my money, putting my money elsewhere. And then you obviously, we all have these visions of investors like Wolf of Wall Street going crazy. So how did you get started?
I'm going to actually turn that on its head. And before I knew about inflation, I began to invest. This is how ill-informed I was. And I don't want anybody to make the same mistakes as me, effectively. And I suppose that was part of the inspiration for starting the group. But we'll start from the start. My very first journey my very first step into investing was I'd heard of Bitcoin. All right. Now, I'm sure lots of people watching have heard of Bitcoin. Back in 2017, there was the Bitcoin balloon that, it basically went into a bubble, didn't it? And it was Bitcoin went to $20,000 in value. So I was walking like lots of people. I saw that Bitcoin was going through the roof in value. And I thought, wow, how can I get a piece of the action? You know what I mean? This was a younger, more juvenile, a more naive me, I suppose.
But, I'm excited to hear where on the graph you bought.
If anybody can see
down
this,
here, hopefully down here.
It kind of went like this, and then I went in here, and then obviously it went to here. So it didn't end well. Let's just say that. But never mind. For anybody who's watching the video, you'll be able to see what I mean. But I'll just explain. So yes, I didn't really know much about finance. I knew Bitcoin was going up a lot in value. I thought to myself, how can I get a piece of the action? But from the little that I did know about finance, I knew that it was in a bubble. Okay, so bubbles pop. All right, of course, financial bubbles pop eventually. So the price was grossly inflated. I knew that it was hysteria. All right, and it was carried away. It was unsustainable. And I thought to myself, if I can just wait to the point where it hits its zenith, it goes back down quite a mark, that's when I'll get in. And in my mind, it was very simple. And I thought I was the Wolf of Wall Street, legit. I thought this was my plan. I thought I'm going to be rich. This is fine. All right.
Do you remember during that time, it was like road to Lamborghini. It was like when Lambo. That was like the hashtag.
Yes. I think it all went to my head a little bit. I got a bit too carried away, but I just wish I would have known what I was doing. And I think that maybe something like what I've created, the group, could be helpful to a lot of people for this reason. But anyway, we digress. What was I saying? So yes, anyway, realistically, when a bubble pops, when a bubble, markets go in cycles. So it's like a bell curve. All right. So you'll hit the top, there'll be a bubble, it'll pop, we'll go back down to the bottom, hover around along the bottom for a while, and then eventually it'll start ascending again. Okay. So the trouble was I had no real concept of how long it takes before a bubble pops. So I just thought, yeah, a few weeks, few months, we'll be good. I'll make my entry. I'll be rich. It'll be fine. From what I know now, when a bubble, the only way a bubble can start again is when all the people who have bought at the top sell and get bored, and then there's no downward pressure on the market and it can go up again. And how long this takes, that's just human psychology. But I had no concept of this at the time. So I bought my first cryptocurrency in February 2018. I bought Ripple, so I bought XRP. Has anybody heard of? Maybe you've heard of it. I'm not sure.
I've had Ripple. I actually bought IOTA at that time.
Oh, that's good. Actually, that looks like it's going to go. I'm not sure when you got in, but IOTA is what I'm watching at the minute, so you might want to hold on.
I got it when like Bitcoin was like at its peak.
Oh,
so it was a bad move, but it wasn't a substantial. My patient was telling me how much money he's making through crypto, basically, and he gave me a tip off that check out IOTA, and I got it, and then the next day it went up by like 25%. I was like, oh my god, I made 25% in one day. This is amazing. I'm gonna get my Lamborghini, and then obviously,
we all did around about that time. But anyway, so I got in at the wrong time. I still have that Ripple, but it's went down a lot in value, and that was the impetus that made me think to myself, what separates me from the guys who are making money versus someone like myself who completely wholeheartedly admits I didn't really know what I was doing and I shouldn't have bought in around about then. But in a way, it was a good experience for me because it encouraged me to learn and begin to read about investing. So ever since then, I've had a broad interest in it. And from then, I've just kind of been plugging away as a dentist, reading a little bit about investing here and there. Over lockdown, that was when I started to get back into it again.
Can I pause you to ask exactly what are you investing in now? So is that too soon? Do you want to comment on that later? So you said now you're investing, working dentist. Sure. You're investing some of your savings and whatnot. What are you investing in? Because
yeah, fair enough. Good question. So I'll just draw the distinction between investing and trading for anybody who's watching right now, just so they can understand a little bit about where I'm coming from. So I invest in stocks, in index funds, and I trade cryptocurrency. So investing is very much when you seek to place your money in investment. So buy something, and then you'll accept that it's going to go up and down in the short term, but you look to the very long term to make your profits. So you might say, I'll buy an index fund. So an index fund is just a collection of shares, just to put it in the simple terms. And then in the long run, as history has told us, for lots of these index funds, big ones like the S&P 500, eventually, when we come to many years down the line, because they inherently go up in value, then eventually those will likely generate us returns that we can use as a pension, or that we can just use willy-nilly, whatever we fancy. It'll generate us profit, essentially. So one thing I'll just touch on, just to give you an example of that, the S&P 500, it's a collection of shares from America, 500 large companies. They're in one fund. You can buy straight into the fund, so you don't have to buy each one of these exactly or specifically. Since it began, 1957, on average, it's went up 10% every year. Okay, so that's on average, up years and down years. I'm not saying everybody should rush out and do that. I'm just saying this is one example. And this is a way that you can grow your money, I suppose, without being actively involved in the day-to-day nitty-gritty by perhaps just buying in a little bit every month. Now, I'm just giving you one example. I'm not saying...
Can I add to that, James, if that's okay?
Yep.
So you made a great point that, let's say, on average, it's been 10%. But one thing I didn't appreciate early on is that what that actually means is that 1 year, it might go down 4%. And next year, it might go up 25%. Then the next year, it might go down 18%. And then it might go up 50%. You know, but it averages out as a 10%. And that's where that number comes from. And that's very important to appreciate, because one thing you have to accept is that when you're investing in index funds, which is S&P 500, it could be an example of, for example, or an index like that you will have ups and downs. But if your time horizon is long enough, like if you think that, okay, this is my pension, and in 25 years time you're going to draw out, then historically it shows that you should be fine, right?
Yes.
But if your plan is that, okay, I want to save up for a house, and you want to buy a house in 3 years time, maybe there are other investments which might be better.
Yeah, very good point, Jazz. So yeah, we're looking to the very absolute long term here. And historically, unless all the historical data that we have wrong on this one particular index fund is incorrect, then that is very much likely, not for definite, but very, very, very likely to generate you profits in the long run. And indeed, many people who manage pensions, this is just simply what they do. So very good book, Ivy League Portfolio. I read on this sort of investing, how Harvard use a bursary to generate more money, and this is how they invest it. They literally do this. Okay, so this is just one example of a pension management fund. So anyway, we've talked about investing, and then, as I say, I just wanted to just annotate the distinction between that and trading. So trading is now again, if we're going to subdivide trading, there's different types of trader. So that would correspond to how frequently you trade and stuff like that. But trading is someone who just seeks to maximize the profits in the short term. They're very much taking an active role in doing it. So maybe they're looking at the charts every once in a while, every day, every few weeks, every few days, something like that. And they're using their money, they're buying and selling, as opposed to just simply buying, which is what investing is. Buying and selling and taking an active role in their money generation. It takes a little bit more skill to do that. Today, I think am I right in saying, Jazz, we're just going to focus, what I'm trying to do is make this accessible to everybody. So I'm going to put the trading to one side for a little bit and maybe just talk a little bit about investing.
I think James, let's do that, because I think dentists, we're a risk-averse bunch. And I think if a lot of dentists, as you saw in the group already, like, hi guys, I've been meaning to look into investing. I don't know what to do with my money. So we have an issue where dentists have some money, maybe some bank accounts, maybe in NS&I accounts, bonds, whatever, and they want to put it to better use. So maybe sometimes when you start looking into investing, you start learning more, you may then also go into trading and whatnot.
Yes.
But I think if you follow investing so you can grasp the concepts and actually get a feel for where your money is going.
That's absolutely bang on. And actually, if I was to know what I know now and go back, I wish I would have done some investing first, because the trading was a little bit out of my depth. Absolutely. Investing is a brilliant way to start, and it's very easy to do. There are people who have investment portfolios that they literally spend an hour on every year, and they look to make buying index funds and what have you, just that we touched upon before, and they buy and hold. And in the very long run, they look to take some money as a means to protect themselves against inflation, which we spoke about earlier.
That is perfect. That is brilliant. Well, the next thing I wanted to do is we talked about the difference you said very nicely between a trader and an investor. And now we decided we're going to go down the investment track. You talked about your journey, how actually it was the crypto boom and how you bought Ripple and how that lured you in. Mine was complete accident. Like I listened to loads of audiobooks. And one day I was looking, I had one of my Audible credits and I was looking through which one to get. And I clicked on a photo of Tony Robbins and it was the book Unshakable, I believe. Was it Unleashed? I think it was Unshakable. And I thought it'd be like how to make you unshakable, mentally speaking and, how to, self-help type of thing. But actually I was listening to his book and it was all about index funds. And I was like, what the hell is this? I've never heard of this stuff before. And it actually, it resonated with me so much. And I urge everyone, don't go from this episode, actually read some books. And there's loads we can recommend. There's that one. I also went on to read something called The Simple Path to Wealth by J.L. Collins. There's loads of blogs out there you can read. There's also a blog by someone called Get Rich Slowly, GRS. Don't know if you've seen that one before. Any reading material that you would recommend?
The best book that I ever read on investing. And you're actually quite, just to go back to what you were saying very briefly, Tony Robbins, I've only really ever heard of him as a self-help coach or a lifestyle guy, but you're actually the second person to come to me and say that he started your journey into investing. So that's interesting that I've learned something today. The best book that I ever read on investing is a book called How to Own the World by Andrew Craig. Have you heard of it?
No, I haven't.
No. So essentially, it just fleshes out everything that we've just been talking about in a lot more detail. And it was the book that inspired me most to begin. It makes some very compelling points about how much money you lose by not being kind of clever with it, I suppose. And the
it's about being proactive. It's not, if you just be reactive and let the nature and the Bank of England or whatever you are, whichever country, and the natural interest rates look after you and inflation and whatnot. You're just surrendering yourself to someone else's, the mastermind plans of the politicians. Whereas if you actually take some ownership and you can actually decide to make a plan for, dare I say, I was going to say financial freedom, but really that's a whole different topic. It's about making sure, like you said, you're protected. That when you come to retirement, you have a good nest egg to rely on. And I think the next point naturally we can lead to from here is I'm a private practitioner. Mm-hmm. I don't have an NHS pension. And that was also a massive reason why I started to look into investing because, hey, I don't have an NHS pension. I need to have some sort of pension. So I started to take it into my own hands. And I read everything I could. I listened to everything I could to arm myself with knowledge so I can make these decisions. And that was a really big, important factor in me. So maybe we'll have to discuss one day how it matters if you do have an NHS pension, because actually NHS pensions are fantastic. And they may actually look after you quite well, depending on your income level.
Yeah.
You have an opinion on that? NHS pension versus investing. I mean, you can definitely do them both, and I think you should if you have that option. But have you ever considered the sort of comparing them?
What I will say is, broadly speaking, it's more lucrative to do it yourself versus having someone who's a pension manager. Now, as to the specifics of the NHS pension, there are certain pensions that your employer will match your contribution. Now, the NHS pension, I don't believe is that for dentists. Do you know more on that yourself? I'm not sure.
I'm not sure. So since I left it, I just don't think about it anymore, and I just crack on with my investments.
Yeah, I have to be honest. I don't know about specifically the NHS pension for dentists, but what I will say is if your employer is willing to match your contribution for your pension, then those are very good pensions because they double your money. All right. Those are a special case. But broadly speaking, I'm very much in the mode of the sort of school of thought that doing it yourself has many advantages over hiring someone else to do it. So I can go into a little bit about that.
Let's touch on that. So we discussed about NHS, and maybe we don't know enough about that to really give advice on NHS pension.
Yeah.
But I think you made a good point that potentially it could be more lucrative. But really, what we can really definitely agree on, and is doing it yourself, i.e., logging into one of the websites where you actually deposit your money into and watching your investments grow behind the scenes, versus handing your money over to a group of people, a third party who then invest that money for you, that's not always a great idea because of...
Yes. So what I'll do is I'll draw the comparison between DIYing it, doing it yourself, and a financial advisor or something like that, because that's that's a straightforward one. So we'll talk a little bit about the pros of having an financial advisor first. So I'm not going to sit here and say by all means that all financial advisors are bad. I'm certainly don't want to come across in that way, but there are a few inherent and distinct advantages to doing it yourself. So what I'll do is I'll talk about the financial advisors first of all. I suppose the advantages to them. I think first and foremost, what a lot of people like, they like somebody to just they just want somebody to completely outsource it to. They just want somebody to take it off their mind so that they don't have to give it a second thought, I suppose, and they can entrust it in their hands. And quite often these guys, what they do is they offer a guaranteed return every year. Now the guaranteed return might be quite modest. Some of them do this, but nonetheless, it's a guaranteed return. It's out of your hands. It's completely, you don't have to worry about it from that point onwards, at least according to them. So I suppose that's the first advantage. I think for me as well as that, what they tend to do as well, and what's quite nice, and what I hear a lot of is when the markets go down in value, when we had, let's use coronavirus as an example, when everything crashed, they offer a shoulder to cry on. They're reassurance. They're someone with expertise. You can talk to them and they can say, listen, I don't think you should do this. They're an advisor. That's what they do. So they're useful in that respect, I suppose. And as well as that, I'm going to talk a little bit about the disadvantages in 2 minutes. There are some very, very, very adept and good financial advisors who are worth their money. It's about shopping around. When we come to talk about in a minute about their disadvantages, you'll see why they have the cards stacked against them. They really, really do. Because what they have to do is they have to generate profit for them and profit for their business first. And once they've had their way with your money, there's less left over. Are you with me? Yeah. Hopefully that makes sense.
100%. I'm just saying for those who can't, those who are listening, I'm nodding throughout everything James is saying, because this is exactly my views on using a financial advisor to manage your money. Because I very much do it myself, but this is because I've armed myself with knowledge over time. I've read these books, and essentially, I think the number one disadvantage, which you're going to come to, is the fees, which may not seem very high.
100%.
But they really, maybe you have some stats. Maybe you've been really good and got some stats for us.
I do actually.
Go for it.
Yeah,
let's go for
a few here. So anyway, the inherent advantages that you have to managing your money versus a financial advisor. So if we were to say, let's say you start out, and you have their interest might not necessarily be aligned with yours. All right. So their interest, they might be the nicest guy in the whole world, but their interests are to generate themselves profit, feed their families, which is fine, and to generate profit for their company. Okay. So because of that, they may be biased towards certain products which generate them better commission than they would do otherwise, which you may or may not think or advisable if you have armed yourself with knowledge. So that's one thing. That's definitely one of the biggest things. This doesn't go for all of them, you know what I mean? But certainly it's something that you want to be wary of as well. As well as that, they may or may not have knowledge of only one area of finance. How many people, let's be honest, actually read around their subject? I'd be surprised if it's maybe 5 to 10% of people. If you can spend some time just going out of your way to learning about these things, then I'm honestly in the camp where I wholeheartedly think that you can already know a great deal about it and be able to know enough to do it yourself based on prior knowledge. As well as that, you've just mentioned the fees. Jazz, I think for me, that's the biggest thing. So you may or may not have heard of interest. Interest is how much money the cost of borrowing money or the cost of lending money effectively. So let's say, for example, we have £1,000, we've got a 2% interest rate. And after a year, if we have 2% interest, which is calculated on a yearly basis, then you'll have £1,020. Make sense? Okay. So let's say the financial advisor's fees are 1%. So what that mightn't sound like much, but at the end of the year, you'll have 1,010. And then subsequently, because you generate interest on your interest via something called compound interest, it actually has a massive effect over a long period of time. So I've drawn up some figures just to give you an idea. So if you invest, now let's say you're very wealthy, you put £20,000 into your stocks and shares ISA. And we'll explain what that is in just a minute, but effectively it's just a bank account that you can invest in. if you put £20,000 in your stocks and shares ISA, after 20 years at 10% interest, you'll have 1.3 million. Now that's pie in the sky for a lot of us.
That's crazy. Let's just reflect on that. Just pause there. Okay. So what you just said there is that if you have 20 grand, okay, and are you suggesting an annual investment of £20,000?
Yeah, sorry. So 20 grand, you put in £20,000 every year and you generate 10% interest on that money. Now, 10% is quite a good return on your investment, but we're just using
it is. But like I said, I want to really go down to the basic building blocks, really go very basic here. So let's talk about, okay, you said 20 years, right? 20 years.
20 years, yeah.
So £20,000, if you put £20,000 every year for 20 years in a bank account, that would make 400,000 because you're just adding up £20,000 per year.
Correct.
What the 10% of compound interest ends up to be is an addition of £900,000.
Yep, lots of money. Yeah, it makes a huge difference. All right. Einstein said the eighth wonder of the world is compound interest. It's the power of it over a long period of time is incredible. And this is what you can hijack using your investments. But anyway, just for comparison purposes, we've heard about 10% over 20 years. If you have 12%, same money, same number of time, you get 1.7 million. So there's a difference of 400,000 there. So if your financial advisor is charging you even just 2%, that's the power, that's the difference that it makes over that period of time. And that's a huge whack of money. That can go some way towards a second home in Malibu. I don't know, whatever you're into, whatever you plan on putting your investment, your financial pot into in the long run.
It's absolutely massive. That is it. So that's the reason I don't use a financial advisor. I do it myself after, I said, reading up. Is to stay away from the fees, which really add up over time. James, have you heard of the rule of 72?
I haven't. What's that?
So the rule of 72 is whatever your interest rate is, okay, you do 72 divided by your interest rate. And that's how many years it will take to double your money with compound interest. So if you've got a 10% interest rate, your money will double every 7.2 years.
Mm-hmm. Okay. Wow. Interesting. That's good. Yeah. Well, then that's just another, that absolutely, yeah, brilliantly. It adds on what I've said, because you can see these 1 to 2% really do add up, especially if you're an investor and you're thinking about taking your profits in the long run. It's massive. And this is where we've talked about other things. This is the main advantage. And this is really where you stand again.
100%. So we talked about doing it yourself versus a manager. Are we okay to move to the next one? I know you probably got loads more points, but I want to cover as much. I'd rather cover more breadth and get a broad area rather than go too deep into one thing. It will be a good taster episode. No, it's great. We love it. we're absolutely loving this right now. So then the next question actually to ask is, what is the best investment in your opinion? So is it stocks and shares? Is it real estate? You saw that poll I put up the other day, right? On
no, I didn't. I missed that. What was that?
So I put a poll.
Oh, no, I did see that on the group. Yeah, I did see that. So I was the only person who voted for crypto on that poll, wasn't I?
Yes, I noticed. Someone voted for watches and handbags or something like that, basically.
Yeah,
so
cars.
You can get any type of business. So go on, tell us, what of those on there, like stocks and shares, real estate, fine wines, cars, whatever. What's the best investment?
Absolutely. Cool. So investment versus trading. So if the best investment, I just want to say, small disclaimer, what's best for everybody, what's best for someone is not what's best for everybody. If we're looking at investing and if we're looking at drawing our profits in the long run, if you accept two things, the first thing is that the world economy keeps on growing, which it always does. It grows by about 2 or 3% every year. That means there's more people and there's more demand for products. All right. So that always goes up. Therefore, there will mean that in the long run, there'll be a scarcity of these products. Okay. So if we accept that, and we also accept that inflation is real, we've already touched upon how inflation happens, the true rate of inflation and things like that. If you accept those two things, so what inflation means is that your money goes down in value with time. So therefore, your buying power of money is less. Then if you accept those two things, then the best investment, or the thing that I think is definitely something that everybody should look into, I'm going to withdraw the word best there. I'm going to go back on myself slightly. The thing that I think that everybody should look into are think about some stocks and think about getting some gold. Those two things will become scarcer and scarcer as time goes on. Stocks, I'm talking about big companies. There can only be so many big companies in the world. As your money decreases in value, the value of those companies goes up in terms of dollars, in terms of pounds, in terms of anything. Gold, there's only so much gold that can be mined. It will run out eventually. Eventually, we're going to have a drought. Because there's more people in the world and this keeps increasing with time, there's always going to be demand. Therefore, if you buy, when I try to buy something for the first time, I look for reasons not to buy it before I look for reasons to buy it. For gold, I'm still trying to find a reason not to buy it. Okay, because I just inherently believe
my
it's
reason
going to go up in value.
not to buy gold is that I missed that dip during Corona.
Oh, right. Yeah. I think trading gold, yeah, definitely. Whether or not trading gold, it's a good idea to buy it right now. That's a different question. In the long run,
good point.
I honestly think I can't see why it won't go up in value. The only reason we can get more gold, the only way we can get more gold is if we somehow start plucking it out of space, but that's a long time off. You know what I mean? But like I say, what's best for me mightn't be best for everybody else. And this is specifically for investing, not trading. All right.
Let me go one step deep. Okay, go on.
Yeah. All I was going to say is to diversify, you want a little bit of both. And then also think about putting your money in other things. A diversified set of assets is one that's the best protected.
So to make that tangible, diversification for you or someone may look like having a rental property, having some decent bit of money collected over years, and you're using your ISA, which is tax-free. Now, USA have their own sort of Roth IRAs or whatever they call them there, basically, which is their tax protected, which is so important because if you just make a standard stocks and shares sort of investment, not protected by an ISA, like you could be paying through your nose through tax.
Yeah, well, capital gains tax, I believe, is 12,300 at the minute. I believe last time I checked, last tax year.
Would it not go as would it not go through as your income tax, or would it actually go through capital gains?
They only charge you income tax in very rare exceptions where you're somebody who's totally sustained from your investments. Are you with me? But they'll only do that because they can generate more money from you. But capital gains is when you sell your stocks, when you sell your gold and the profit becomes realized, so it's crystallized and you actually have that money. So you've converted it back into cash, or you've traded it for something else of equivalent value, in which case it means it's crystallized. Then at that point, you're liable for capital gains. And I believe the figure to be over 12,300, at which point you begin to pay tax on it. So if you invest in a stocks and shares ISA, there is no such thing as capital gains tax, and you can put things up to 20 grand in every year. So that means if you can generate as much money as you like and you don't pay tax. There's also a SIP as well, which is a self-invested personal pension. So these two things are unique to the UK. And I think that a lot of the world would be very jealous if they could get their hands on these investment vehicles because they're incredible, really. So these are two things that I'd love to flesh out, but I think very much more of this on the group and things of this nature.
We can touch on SIP in a second, but I'm just going to finish my sort of example. So someone could have a rental property. They could have money away in their ISA, so it's tax-free. They could be putting money away in a SIP as well. And maybe they've also been investing in gold. And maybe they have some cash lying around, because sometimes, it's good to have cash lying around.
Always good to have some cash. Oh yeah, definitely. So yeah, that's just you need to have some at hand, because not everything. Yeah, well, anyway, we'll get into it, but yeah, it's good.
Absolutely. So that could be an example of one way that someone could dentist could diversify. You got your fingers in a few pies, not just all in stocks and shares, not just all in gold, but you're sort of spreading it out. You've got a bit of real estate in there as well. So there's a lot of police in Leeds.
Oh yeah, I think I think it was an ambulance actually, but but yeah, sorry about that. I'm right next to a window, so you might have to just deal with some sirens.
That's fine.
Yeah, I think I'm next to a hospital actually.
Okay,
annoyingly,
not an issue,
but never mind.
Not an issue at all. So, do you want to explain to everyone what a SIP is? Because some people might be listening and they might not know what a SIP is.
Yeah, so it's a self-invested personal pension. So you basically put your money in, similar to a stocks and shares ISA. The catch is you can only withdraw it when you're 55. When you put your SIP, when you put money into a SIP, the government contribute towards it. They reduce your taxes. When you take your money out of a SIP, they do tax you. When you put your money in a stocks and shares ISA, you'll be taxed beforehand, just as you normally would do on your paycheck. However, that money is tax-free when it comes out the other side. Another advantage is you can take money out of your stocks and shares ISA whenever you like. So it all depends on flexibility and everybody's.
So James, perhaps a good time for someone to consider a SIP would be when they've maybe had a particularly good year at work.
That's a good question. Yeah.
Right. They've had maybe a good year at work, and maybe now they're looking at a really big tax bill. But now if they invest some of that money into a SIP, your tax bill will reduce. Yeah. And actually you've put money away that could also, because you can your SIP could be in a stocks and shares sort of pension. Yeah. So then now when you're 55, some years later, when you withdraw that money, yes, you'll pay tax when you withdraw it, but if you be clever about how much you withdraw, you can withdraw it at a lower tax rate. But also your pot will be bigger through the gains from stocks and shares. Have I interpreted SIPs correctly in terms of how I think they can work best for us?
Yes. The short answer is yes. Although I think that it gets a little bit funny if you earn over 150 grand. At that, you actually can put less into your SIP. But that's a story for another day.
Okay.
I think it's and very much it's not either or. You can have both. But these are the small print and technicalities. But broadly speaking, those are the pros and cons that I've just outlined.
Perfect. When should you start investing? Point number 4. When should you start investing?
The sooner the better. The sooner the better is always the answer. 2 reasons. First of all, you can take advantage of compound interest that we spoke about earlier. The sooner you do that, the more lucrative your gains are. As well as that, the more you can educate yourself and learn. The younger you are, the more time you have to do that.
Very good. I like those 2 answers.
The trouble is. Now I've been there before. I had no interest in finance, in money, anything like that. You couldn't shake me to get me in. I just didn't care at all until I learned, I suppose, just how much we lose out and how much we're taking advantage of, I think, really, by keeping all our assets in all our assets in cash. And these are the reasons that drew me to get into it. And I do appreciate from the outside in, it looks really boring. I 100% totally get that. And I was in that boat for a long period in my life. But money to me is very much, just like what we said earlier, it's very much a means to an end. I just want a happy life where I have freedom. It's not about the money. It's about what it gets me.
It's about security.
Well, yes, there's lots of reasons, It's happiness, it's security, it's not having to worry about it. And these are the reasons why I think everybody should at least think about it.
That's amazing. Great summary there. Have you got a little bit more time to just explore a few more philosophical things?
Of course, mate. We've got all the time in the world.
Fantastic. Well, one barrier that I've had to face with investing, and I'm sure some people listening may also have this, is that I'm married. My wife is also a dentist. She's a community dentist. But her philosophy on investing is polar opposite of mine. Right?
Yeah.
Now, no matter how much I say, Sim, read this, read that, she's just not interested. Okay. So my wife likes to open up her bank account and see that all the cash that she's saving is there and no one can take away from her and whatever and is there. And she's very risk averse. So when I even mentioned that, what I'm doing with some of the money that we save together, because ultimately what's mine is hers, what's hers is mine. But we've almost automatically diversified because she's very much in one camp and I'm in the camp that, okay, we have to invest. But I think it's really good that if you start investing, you need to have if you have a significant other in your life, to have that conversation about what your, so are you risk averse, what your risk level is, volatility, the fact that over time you're going to be facing years like 2020 where your investments go, but then that actually if you if you keep investing, you sort of average it all out, and then eventually it will go up again. So these are sort of things that you need to have discussed with your family or your significant other, and the sort of investing hats that you put on. So that's one barrier I face was my wife. You know, I'd like to be able to put more money into stocks and shares, but I feel as though my wife gets uncomfortable about that.
Yeah, I can see why someone might have that perception. And I certainly sat in that camp for a long time. And for me, it was very much a mindset thing. And when I learned about, just as we just touched upon, when I learned about how much you actually, how can I say this? You lose out, or you lose money just by leaving it in the bank. This was the thing that flipped it on its head by me. And then I actually thought to myself, well, actually, it's actually almost less risky in a kind of roundabout way to think about to diversify and think about investing some of your money. So it just turned it on its head for me, effectively. But I think that it has this connotation. You're right that it is risky amongst a lot of people. And there is risk. There's always going to be risk. But there's risk to leaving your money in the bank as well. It's about risk management, doing the least risky thing.
Absolutely. So I'd encourage anyone out there, before you start just, obviously engaging in this fantastic Facebook group and learning and stuff, but it's really important to discuss with your husband or your wife, your partner and family, and actually make a financial plan together for the future. Like what is it that you want at age 50, age 55, age 60? And actually, what are you saving towards? What are you investing towards? What about property? What about this? So it's important to sort of take a long-term view on this.
Definitely. Always worth thinking about, 100%. As I say, yeah, always best to have a long-term plan. And that was what you've just talked about there, Jazz, was very much one of the reasons why I got into it as well. In the long run, I want to be happy. We all want to have a happy retirement, don't we?
And on that note of retirement, have you heard of the FIRE principle, or the FIRE group of people, FIRE? Have you heard of these group of, or this philosophy of life?
No, I'd love to hear that. What's that?
Okay, so something I've subscribed to for the last 2 years, and I'm actually making myself quite vulnerable talking about this on the show, I guess, but it's not something, so I am firing at the moment. I'm going to come on to exactly what that is, but I'm not firing at the rate I want to be firing because, like I said, my wife has a slightly different sort of viewpoint on money, so we're sort of slow. So what firing is this: financially independent, retire early.
I like it. Awesome.
So there's a whole group on Facebook, and I'm part of this. I don't see any other dentists on there. I'm sort of always trolling on and whatnot. So basically, it's a group of people who come to the conclusion that they want to work, and then they want to save, really aggressively save money. They want to have a high savings rate. We're talking 40, 50% of your income to be saved, and then invested into, let's say, stocks and shares. And once you've reached your a predetermined amount, that is your FIRE amount. So once you've reached your FIRE amount, so I've got my FIRE amount, I know that once my pot reaches that amount, I don't have to work anymore because I need to. I can work if I want to, but I don't have to work if I need to. And then essentially what you do then is you live off the interest,
Yes.
At that point, and then you just draw money from your Vanguard, or your Trading 1212, or your AJ and Bell, or whatever. So there's a group, these people called the FIRE group, which also I take a lot of inspiration for, because it encourages you to think about your future, save, but also that was one way I learned more about investing as well. In fact, this FIRE group of people introduced me to a lot of books, a lot of reading as well.
Well, yeah, I mean, I think what you said is really important, because when I say the word retirement, we automatically have this preconceived notion or connotation that we have to be old to do that. Why not retire when we're younger? If you sit down, you do the math, it's possible. And the barrier between being the person who has to work their whole life and maybe never retire versus someone who can retire very young is literally just financial literacy. And this, I think, is just a really powerful message that I suppose is really important to share.
I love that. So for everyone, I encourage you all to join the Dentists Who Invest group. Learn more, interact. And like I said, I'd like to see dentists all over the world joining it. I'd like to learn from a lot of guys. Maybe one day I'll get into trading if my wife will let me. And then I can pick up some tips. But very much, I'm an investor.
Got to keep the boss happy. I don't want anybody to lose their wives. Disclaimer. I don't want anybody to it's not my fault.
James, any last words, any closing comments to wrap up this sort of very quick fire, very sort of rough and ready introduction into investing for dentists who have sort of been thinking, what's this all about?
Cool, absolutely. Like I say, just going back to the education point, the only difference between somebody who makes money when investing in trading versus someone who loses money is 1, education, and 2, mindset. So if you can educate yourself, the mindset comes from that, by learning about psychology, by learning about the various ins and outs of trading, and also about how you can be clever with your money. It's just education. That's all it is. And when you start to learn about something, my hand on my heart is I think it becomes inherently interesting to you. So the more you learn, the better you become at it, the better decisions you can make in the long run. Okay, so like I say, education, really important. That's the first point. I think it's absolutely amazing. And it's the difference between gaining something and losing money. As well as that, I really put my hand on my heart when I say that I think investing and trading should be a life skill for everybody. And the reason that I say that is because of the reasons that I outlined before, and it's just protecting yourself and making sure that you've got a happy future going forwards.
Amazing. James, thanks so much for coming on the show, my friend.
Mate, thank you so much. This has been brilliant. Yeah, if you ever need anybody to talk on it again or anything like that, you know where I am.
We might wonderful. Do. I think because I think sometimes the very lovely dentists that listen to the show, and I appreciate them so much, we're sometimes on a journey together, and I'm learning about personal finance all the time as well. And what we might find is that a year or two later, once we've all joined the group and we're all at that, we'll all start to invest, so we start to think about our future, and maybe we want to start getting into more advanced techniques. Then we can start talking about being a bit more clever. So maybe there is a part 2 in this. Hey guys, thank you so much for listening all the way to the end. I hope you found loads of valuable from all those tips that James Martin shared with us. He's so knowledgeable. He's so full of passion for this area of investing and finances, which is really great. I'm going to go and buy some gold ASAP. Thank you so much for all of you who message about the benefit or the gain that you got from listening to Professor Paul Tipton's episode. I thought he was so good, so direct, so many gems in there that I've sort of earmarked him again for a future episode on post-cause and crowns, which I think will be quite good. So watch out for that one in the distant future. I think there's so much more to cover between now and then. But as always, keep reaching out to me. Keep letting me know what you like, what you don't like, so I can help grow this podcast along with you. Thanks so much for joining, and I'll catch you in the next one.